So, welcome everyone to this on the record, off the record conversation. This is actually our first in our SMB and tech series. We're planning a series of conversations with small business owners and technologists to talk about things like funding, scaling, and exit options for non-tech, high-growth businesses, as well as other issues that could be solved with technology. And we're really excited to have both Jonathan Bragdon and Terry Billen here today with us. So Jonathan Bragdon is managing partner at Capacity Capital, and our product advisory collective is actually a collective venture partner, Capacity Capital. And this is our first on the record, off the record with Jonathan. And Terry Billen is a new e-commerce entrepreneur who has secured large contracts right out the gate, founding her business. I will turn it over to them to do their own brief intros, and then I'll have some questions for Jonathan before we go into a mini pitch with Terry.
I'm Jonathan. I only went over to the dark side about 5 years ago and started a venture fund. Before that, I was building tech companies, some venture backed, some bootstrapped, but always needing outside capital along the way. And as I did that, I learned a lot about a lot of different types of capital. And after building a studio model where we built companies inside of one of our other companies, I wanted to build a fund to get those accelerated out. And then we sold out of that before I had a chance to do that, but I couldn't get the fund out of my head. Ended up building a venture fund. How hard could it be? It was actually pretty hard. But one of the unique things that we do that I'm just obsessed with is working with founders on matching the right type of capital to what they're actually building. In reality, VC should be the last choice. It's the most expensive. Revenues first. So the past 5 or 6 years, that has been a big focus of myself and my partner. This is a really important topic for us, and I think for businesses in general. So I'm really happy to be here.
I'm Terry. I am one of the founders at Ask Us, and we are a full service B2B and enterprise solutions partner. And we are focused on powering growth through smart procurement, scalable internal corporate e-commerce sites for our customers. We deliver that end-to-end brand strategy and curate the high volume merchandise for our customers. And we provide procurement services and product to their businesses. We work with enterprises, SMBs, even ambitious startups. Why I'm here today is because we have landed our first contract with a company that is supported by a publicly held company that has revenue in excess of 14.5 billion. So we're in a really good place, and I'm really happy to be here and be on the record, off the record.
Jonathan, I'm really excited for you to share your message to all different types of companies that VC is not the only path, that there are other options. And we're also at an interesting time where VC and other types of investing are going through a lot of changes. With that, I'm wondering if you could share your perspective on how ownership and exits are also changing in recent years.
A lot of what we've seen, you've seen a lack of liquidity in the market, which basically just means if you're putting money in a company, you want to get money back out. And a lot of times what a VC needs is that company to sell. So M&A or go public. And fewer companies are going public. The M&A market slowed a little bit, but what has really slowed down has been follow-on investing. The further the A or the B or further down the alphabet you go, the more difficult it's been to raise capital. The rounds have slowed. The time between raises has just extended. That just puts a crunch on a lot of different companies. VCs have had to think about temporary funding, bridge funding between rounds if the company is still burning. And so a lot of emphasis has gone back to companies that are capital efficient, that don't burn as much capital between rounds, don't use as much before they get to break even or to exit or whatever the next equilibrium is. It's put what I think, and this is a contrarian view, but I think it's a healthy stress on the system. And I've always been this way. If you build a business, you should be building a business, not just chasing check to keep it alive. There are industries where that has to happen, but there are very few companies that really need that kind of trajectory to make it work. So I'm actually glad there's some stress in the system. But the trick to that is founders just don't know where to go for a check typically, because a lot of founders, especially in the tech world that I came from, it was almost, step one, decide to build a company. Step two, go to a pitch competition and raise equity. And that's not reality for 99% of companies, nor should it be. Where are all the different types of capital that can help? And what really fits? How does a company hire money instead of just chase a check?
Yeah. And how do you think this is changing how startups and small businesses are thinking about exiting or are being asked to think about exiting? I remember a decade ago, you had to have an exit plan as part of your pitch.
If you're pitching to a VC, I think that is still true because that's the business of venture capital. That's how you get the money back out, is some kind of exit. So they want to know that there's some thought around that. But from a founder standpoint, this dynamic of it's a little bit more difficult to get capital, especially the second round of capital, means it's wise to have a business model that could potentially just create a bunch of options instead of having to raise money the next round. And it's even birthed a pretty good industry where the goal is not to build $1 billion business, it's to build a $10 million business and potentially sell it or just have it as a cash cow that you just build along the way. These aren't really new terms, but they're starting to get loud. Like we've heard seed strapping a lot, which we've had that in the Southeast US for 10 years. Seed strapping just means raise once and never raise again. Bootstrapping just means don't raise outside equity. So this was the middle ground, but I think it's a good way to build a business.
What do you think that owners should really be considering as they're building a high growth business?
I think that the idea of building a business should really focus on the business and not the funding. But inevitably, with a startup, there's going to be some kind of cash gap, right? And you've got to fill it somehow, unless you're getting revenue from day one, which is relatively rare. So the question becomes like, how much capital do you need? And then what does it take to fill the gap? And what is even available? Because if you're not 6 months old as a business, there's no way you're going to get a loan from even what's called a CDFI. A regular bank's not going to give you a loan for 2 years. So it's really difficult to get a loan. And I think the approach needs to be one that is much more in line with hiring talent. You're hiring money because this money is going to have different demands on it. So if you're hiring money, if you hire VC, you're hiring a partner that's going to be in the business as long as you are typically, and maybe longer if it doesn't go well. You might get kicked out. But if you are hiring purchase order financing, that's like hiring a temp for 60, 90 days. Debt wants to go against some kind of asset that you already have, whether that's money in the bank for a bank or equipment that you're getting loans against or future revenue. Those are assets that debt likes to balance against. Risk capital on the equity side is really balancing against some future transaction. And based on what you have in the company and in the model that you're building, that really dictates what what we call a capital stack actually looks like.
I was primarily wondering if there are investor benefits to a strategy of seed strapping, just because most of the potential investors that I have talked to seem to indicate that any business that even hints at a strategy of becoming like a cash cow and not going for an exit strategy is something they don't want a part of because there's no return on that investment. What's the draw to an investor, an early stage investor, to put in money for a seed round or a pre-seed round if they think that's all that's necessary?
That's a great question, Maddie, because this is another example of making sure that the kind of money that comes in aligns with what the goal and the model of the business is. There's lots of different flavors of investors. Most venture capital investors have a very specific path that they want you to take because the only way they're going to get their money out is the exit. And most are going to say exactly what you said, which is basically how far can the valuation go up before the exit? It's really hard to value early stage companies. So the way you do it as a fund is you look at the next round of investment that went in at a next higher valuation. They call it a markup. If they don't have a markup, in other words, another round of investing, they cannot tell their investors that the investment value is going up, even if sales went up 100 times. So they use that as a proxy. So a lot of funds definitely don't want you to raise one round and not raise another one. But there are funds that, and we happen to be one of them, that actually look at if you raise more and more money, the bar goes higher and higher. If you raised $100 million, you've got to sell the company for $1 billion for it to work out for founder and the investor. But if you raise $1 million, but you're capital efficient enough to grow incredibly fast, the advantage of not raising more money is you give up less dilution. The founder keeps more of the company, but the investor that went in early also keeps more of the company. So when they exit, it can be a lower exit because they own more of the company at that exit. It's a different math.
If there's a strategy for that, is it better to do almost a priced round early on in the seed? Maybe not a 409A, but just an agreement for a set percentage of equity for a given investment with the agreement that you're not going to seek to raise more.
So the name of the game is more optionality. So structure a deal that is okay if it raises another round. It's okay if it doesn't, and there are ways to do that. But most of the time, the investor has a very narrow view of what should happen, and they're just hoping for that outcome. So if you, as a founder, instead of contorting the model to fit the funding, which happens a lot, build the business you want to build with the model you want to build with the outcomes that you want to have. This is one reason that revenue-based financing has stepped up quickly, is this open-ended growth path. Now that's debt, but it's debt based on future revenue. So that's become much more popular. There's also equity vehicles that you can redeem back the equity rates, and it looks a lot like revenue-based finance as well. And so there's some really creative things that have come out. There's a few misfits like me around the country that have done some work in this for this very reason.
Great question, Maddie. And Jonathan, kind of building on that, what signals do you see when you're speaking with companies that let you know that capital from capacity capital or maybe somebody else would really be catalytic?
Because we do equity, we're looking for founders that need risk capital. Risk capital just means there's no assets to borrow against or not enough to get enough capital in to actually grow the company as fast as you want it to go. So that gap is risk capital, making sure the need is there for that. For capacity, we are looking for very capital efficient businesses. So that optionality is more possible at the next round where they choose to raise more money or choose not to. We don't invest in deep tech or FDA approved SBIR 1, 2 phasing stuff that takes 3 to 5 years before revenue. It's very hard for us to do that. We like that 12 to 18 month jump. That takes capital efficiency. A lot of venture funds, I would say most of them really want that really long-term cycle because they want it to be really big. They don't want it to be small.
When it comes to non-traditional deal structures, like what you've been talking about, when have you found it useful, beneficial to do things like revenue agreements or redeemable equity, revenue-based financing?
This funding either leans equity, as in a right to ownership, or debt, as in a right to cash flow or being able to grab assets if it's not paid back. And so you really determine whether a company has assets or not at the beginning. And then gauge that against how much capital is needed to make it grow. So anything that's tied to the payback, like some kind of return for the investor along the way, it could be redeemable equity or it could be revenue-based finance, depending again on what that is set off against. But the payment just happens to be monthly or quarterly or based on revenue or based on distributions. There's all kinds of ways to do it, but it can be incrementally along the way because if that fits the way that business is being built and what the model of the business actually is, right? That takes anything that gets payments along the way, that needs to be a high margin business. There's got to be some scalability to it. A lot of times it fits relatively well with SaaS and tech that can scale and create some recurring revenue. That helps, but doesn't have to be. We've done that in packaged goods companies that had high margins, platforms, even services company that have platforms that actually stack. All you're doing is matching up the business model with different types of capital that fit along the way, or the money comes back way off in the distance at an exit or some other kind of transaction.
Terry's looking for what we'll call alternative capital, alternative to VC.
Yeah.
Do you want to start by sharing a bit more about the business and however much detail you're able to share about the type of funding and the amount of funding you're looking for?
Yeah, sure. As I mentioned earlier, we started our company and formed it 5 months ago. So we're very new. We fall under that same category that Jonathan brought up, that if you're not even 6 months old, you can't even get an SBA loan or any kind of loan for that fact. Without having 2 years of financials, a bank's not going to give us any money as well. We decided to go out and bootstrap so that we had the autonomy to control our destiny. However, because we were fortunate to land and secure an exclusive contract with a large company whose parent company is publicly held. Their revenues last year were 14.5 billion. We were fortunate to get POs right out of the gate. Ever since, we've probably fulfilled 9 POs since then. We have a pipeline of anticipated POs for about 4 million. Within the next 2 to 9 months, we'll be fulfilling those POs. So even though we signed this 2-year agreement, we've got terms with them, we built this particular customer a B2B internal e-commerce store. We took their products from 20 and curated a product line that consists of 240 line items now. I just want to give you that backstory because I know that our story is probably not normal. And in fact, we didn't think that we would be scaling this quickly, but it became pretty evident early on that the volume and the predictability of the orders that we are going to receive, that we needed to find a source. Our POs just for one particular item would be probably in excess of 500,000, and that's just one PO, one item. So if you can imagine, starting out, can't get funding anywhere, we have decided to go the route of PO financing because we need that gap capital to fund our cost of goods. And of course, we need a little working capital to go along with that because of the amount of business that's coming towards us. Once we began receiving these high value POs from this division of this publicly traded company with dates that we know are going to come to fruition, it put us in a really great position. We didn't have to go down that VC route. We didn't have to trade equity for long-term capital. We needed short-term capital to fund our specific deliverables and the POs that we need financing for. So that will allow us to meet our surging demand without diluting our ownership. So we're at this point, because we're in this unique position, we had to find a unique way to get capital. Bootstrapping wasn't going to handle it because in the next 60 days, we're going to need this capital. We've structured it a combination of where we would start with front end and get PO financing, and back end, then we would switch that to more of a invoice factoring scenario where there's less percentage. This works really well for us because we have the margins in there to be able to allow for PO financing. It allows us to address the need for cost of goods. We don't want to just chase our growth. We want to structure it, and we want to structure it under our terms. So we know that it's coming down the pipe. So we're moving fast and furious to make sure that we have everything lined up so that when purchase orders come in, there's no hiccups.
I love that you're moving so quickly and the clarity is there because I think you're dead on. Going back to define the problem is you're having to buy inventory before you're actually delivering a product.
Mm-hmm.
Before the customer pays you, you need to buy inventory. But the customer is actually committed to buying it from you. So they have a purchase order. So somebody willing to loan you money based on that purchase order because they believe that customer will pay you in 30, 60, 90 days, whatever it is. So that's what that loan, that's what purchase order financing is. And that can get funded any number of ways, but typically it's just because of that gap. And you could continuously do that. It's relatively expensive from an interest standpoint. Eventually you might get to where you're 2 years old and you have a line of credit from a bank or you can get one that costs less than purchase order financing. So you can move into that type of funding to fill that gap. Or you've made so much margin on those products that you govern your growth so that you just grow with the cash that you've made to buy the inventory and you don't take any outside capital. But if you want to grow as fast as you want, you need something to fill that gap. And this is also, by the way, why just as many companies go bankrupt growing as they do shrinking. It's just the cash. So that purchase order financing, you're hiring a temp. This is something that a lot of founders get stuck on when they're looking at capital. They start to line up a couple different options and they think about, oh, if I could get a loan, it would cost me 8% or 7.5%. But this purchase order financing, I get 100 grand now to buy inventory and I have to pay 125 in 90 days once I get paid. And just look at that and go, wow, that's 100% interest, which is true if there is other types of capital available. But a founder needs to be looking at this from an opportunity cost standpoint. If they're buying $100,000 in inventory, what are their margins? Are they going to make, what do they get paid by the customer? Are they getting paid 200,000? Do they have 50% margins? So really it's what am I willing to pay to get $100,000? Because I spend 100 on inventory and I get paid 200 from the customer. What am I willing to pay to get 100 grand? I'm willing to pay 20 grand, 25 grand to get 75, but willing to pay 20 to get 80. It's an opportunity cost calculation, right? Now, that's really expensive money. So you want to get less expensive money over time. But I see a lot of founders just refuse to grow because they won't take expensive money. And so calculating out the expense is not really the right way to look at it unless you're comparing it to other types of capital. You look at the opportunity cost, and if it costs less and it's worth getting the sale, then you get it. But yes, over time, your options actually open up and you get more ways to actually fund this thing. And eventually you might not need any outside capital, built up reserves or whatever. And that's the cheapest money.
There's more than just, hey, I'm going to get a PO finance and I'm good. There's so many other things that led us down this path. If you have product, you have to look at the full production cycle. Where are my products located? Do I have to take them from manufacturing? China, Pakistan, India? Where am I taking my goods from? What is the lead times on getting my product? Because that actually gets into the PO financing length of time. We know where our inventory is coming. We know what our defined lead times are. Those are really important aspects to also look at it. Also, what you're putting out, what you're getting back in return. And then what is the size of the PO? That is also another thing that is crucial. The revenue we're getting back is a little bit higher than maybe $100,000 PO. Our investors, if we did 2 or 3 POs with them, by the time they're financing the third PO, they're actually already received their money plus their ROI back on that first PO. So they can actually use that same capital to fund our third PO. So it's super beneficial for an investor. It works out for us because how this company works, the better we do, the more we fulfill, the more business we get. And this is just the tip of the iceberg for us. Keep in mind that our situation may not be similar to you, and it could be a little unique, but there's so many more things that need to be considered than just, hey, I'm getting PO financing. And what is that rate?
One of the things that's important with this, somebody who's writing the check is thinking about getting the check back plus whatever the upside is. In a purchase order finance, they're actually looking more at who wrote the purchase order than they are the company they're providing the money to, because the risk is that sale doesn't get paid. So if it's a really big, well-known company that's written the purchase order, that's less risk than a single store down the street who wrote a purchase order, which would be, there'd be more risk with that. But that's the way they're operating. They're mitigating the risk based on who's buying the product, because they probably wouldn't cover the risk with just the company. Like this happens with direct-to-consumer companies doing packaged goods or going through Amazon. There is no purchase order. It's much more difficult to buy for inventory for a direct-to-consumer model than there is one that has purchase orders from a big buyer. And distributions or wholesalers, if you can get purchase orders, that those can be financed with debt, which is why a lot of the direct consumer companies will raise risk capital because they can't get debt to buy inventory on the front end.
And also, we're focused on B2B and enterprise companies within recession-proof industries. So that would be something like transportation, logistics, commercial, industrial, that type of stuff. So that's also another part of the entire piece of getting funding.
It lowers the risk for whoever's writing the check. Yeah.
So I'm curious what your take is on a company like Terry's getting this kind of capital and like what that cost of capital might be.
Terry's making her own decisions too. I don't want to give up equity, so I don't want risk capital that takes a piece of the company. Put that off to the side. I'm less than 6 months old, which means I can't go to a bank or CDFI and just get a loan or line of credit. So put that off to the side. And now you've narrowed it down to what assets do I have that an investor is willing to invest against or lend against. And what it comes down to is, sure, believe Terry can do what she can do. She got experience, but really it's more, what is this business model and how secure is the business model? And then the paper behind that, if she's getting purchase orders versus just, I hope to get an order someday. And it's just a calculation. So the more risk, typically the more cost is involved, because Terry's got purchase orders from really big companies in established industries. The risk is lower. So her cost for purchase order finance specifically is going to be less than somebody else who's selling to not as secure a buyer. So all those are calculated in. The founder needs to know a lot more about what actually fits their business. And it's really hard to do. But one of the misses that happens a lot is this over comparison of expense, because what needs to happen is what is actually available to me and what actually fits what I'm doing, and then look at the cost. And when you look at the cost, it shouldn't be, oh, the interest rate's high or low, or the multiple on the money is really high or low. It's what is the opportunity that this money gives me, and is the juice worth the squeeze? Am I willing to pay this to get this? It's not just, am I willing to pay this? If you can grow profitably with enough margins, who cares what it costs at the expense line? You need to optimize that over time to where maybe that cost goes to zero. But at the beginning, if you're trying to grow, it's opportunity cost.
Right. Just like in technology companies, there's a huge cost for R&D. You know, you're not getting paid that R&D out of the gate. You have to amortize it over time. So that is a huge point, is that what is the opportunity worth? We have been able to get much lower rates based off of all of the factors that we put together. We position ourselves as a specialty company. So anything that is branded, it's theirs. it's committed, it's irrevocable. So we know that we're super fortunate in where we're sitting right now. But in our position to support just what Jonathan said, we are willing to do those opportunity costs. Basically, we're willing to do what it takes to grow, because if they don't grow with us, they're going to grow with somebody else. And our goal is to grow with them, not watch them grow. So it's very critical for you to determine what that means, how long you're going to be using the funding and the financing,